Hello, greetings. Welcome to Dividend Blasters. This is our 98th video. Topic today, Covered Call ETF Royal Rumble. Who wins, GPIQ or QQQI? So, the last couple of videos, I've talked about GPIQ and QQQI. The focus was more on GPIQ. Full disclosure, I own both. I like them both. I'm a little more partial to GPIQ, but I'm going to tell you why. Uh, and guess what? That could change. That could change just depending on how things go. So I'm going to talk about both of these and tell you which one, in my opinion, is the better covered call ETF. That's the objective. First, a disclaimer. What I say is not financial advice. This video is for information and education. It reflects my own personal opinions, my research, and experience as an independent investor for more than 30 years. So do your own research, your own due diligence before making any major financial investment decisions. Now, I'm going to go through these next three slides very quickly. I actually had these three slides in the previous video. But if you didn't see that, I'm going to cover it here, or you can go back. But I think it's important just to know it. And if you're very new to this, and you might be, a covered call ETF, it's an exchange traded fund. They invest in stocks. And why are they special? They generate additional income by selling covered call options on those stocks. The call options are covered because they already own the underlying shares. This strategy allows the fund to collect option premiums in addition to dividends of those stocks, which are typically distributed, and that's what we call them distributions, to investors. Is enhanced income. Okay, what are some key benefits? Boosted income. Okay, and I'm gonna cut to the chase for the fourth bullet. You're gonna get a distribution payment, very likely monthly. That's your dividend. It's more than a dividend. It's a distribution. And that's the appeal of it. You're not having to wait every quarter. You're getting something monthly. And today there are a growing number of covered call ETFs that are paying out distributions on a weekly basis. Another feature or benefit is that these investments reduce volatility. That premium income you're collecting is a nice offset to any market downturns or corrections. Simplicity. You don't have to sell covered calls on stocks. That's a little bit of work. They're doing it for you. Okay. Now, full disclosure, I love selling covered call options on stocks. I've sold several hundreds of them, and it can be quite lucrative. It's a lot of fun too. But you know what? It's work. So this is one other thing that they will do for you. All right. What are some of the considerations? Limited upside. When you invest in a covered call ETF, guess what? That price appreciation is not going to skyrocket. It's not an Nvidia, right? It's just it's not a Google or an Amazon. Not going to happen. No, it's limited. The gains are capped because you know you're it's an ETF. You're getting a distribution, and a lot of times when covered call options are being uh, exercised, there's an assignment and shares are sold. So there's just limited upside. I'll talk a little bit more about the capped upside. But really, what the major takeaway here is that there's an underperformance price wise, especially in a bull market. Uh, if the S&P 500 goes up 10% in a month, that covered call ETF is not going to go up 10%. It's going to go up a fraction of that because you know what, you're getting part of your return. You're going to get a much lower price return. You're going to get more in distributions, which is going to account for your total return or part of it. Another consideration: you pay more. Okay, these guys are overlaying an options strategy for you, so you don't have to sell covered call options on stocks. They're doing it for your behalf. So there's a administrative fee, or what we call an expense ratio, basis points that you pay annually. Tax complexity. So that complexity is that basically you are not just getting dividends, you're getting monthly, you're going to get premiums. We call it a distribution. Part of those premiums, or actually distribution, also includes Possibly, very likely, a return of capital, just depending on the performance of the ETF. And I'm going to touch on this briefly, but basically, there's future tax implications for investors that makes it a little bit more complicated. Uh, and just kind of in a quick and dirty explanation, return of capital is very likely going to happen if the ETF is paying out more in the distributions than they're taking in the premiums. And that's a real thing. And that leads to NAV erosion. That's basically high yield and regular distributions are going to erode. They always will reduce the NAV, but it can be reset if there's enough options premiums coming back in. And it's calculated every day. But you know what? If you look at it over a long period of time, a longer time horizon, over maybe 3 or 4 months or 6 months, and you can track the NAV. Go into Morningstar. If you see a precipitous decline in NAV, that's something called NAV erosion or NAV decay. All right. A little bit more about NAV. It's the total value of all the assets held by the ETF, stocks, bonds, cash, minus any liabilities. So distribution payments, they have to pay out. They're required to pay out. It's divided by the total number of ETF shares outstanding. And it's calculated every single day. What is it used for? It represents the fair value of a share of the ETF. NAV provides a reference point for investors to assess the actual fair value of holdings relative to the actual underlying assets. This is good. Market price versus NAV. You can do a comparison. If you find out what the actual NAV is, go into Morningstar, which is a good resource for NAV. You can do a comparison. And you can see that if the market price of the ETF is trading above the NAV, it's trading at a premium. If it's trading below, it's trading at a discount. That market price really depends on supply and demand, but it typically stays close. All right. And this whole thing about ETF's creation and redemption mechanism, that's a whole other video. But I'm hitting the important takeaways here for you. So NAV erosion, basically funds that maintain or grow NAV while paying sustainable distributions. Sustainable is preferable. This is my opinion. Okay. Excessive NAV erosion indicates that the fund is paying out more than it earns, and it may not be suitable for long-term investing. So I've said this like 3 times, but I wanted to say it again because I think it's a really important point. A little bit more on NAV erosion, and then I'm going to do the side-by-side comparison. So the value of will basically decline over time if you have NAV erosion. This is because the fund is paying out high income distributions really that are not sustainable or sufficiently offset by asset growth, options premiums, either one or both. For covered call ETFs, the capped upside and frequent payouts can lead to a shrinking NAV. So when I say capped upside, what does that mean? That means if the option is assigned on a covered call and the shares are sold, the upside is missed and the asset value is not going to increase. You got the premium, but you don't have the growing net asset value. NAV shrinkage happens especially when market returns are strong. Okay, options are assigned, shares are sold, or options are insufficient to cover losses in the underlying stocks. Those two go hand in hand, and it's really not good, in my opinion. Now, look, let me just say this. There are a lot of really wonderful people, friends of mine, smart people that like high yield distributions in their covered call ETFs, and they swear by them. That's great. And you know what? That really, maybe it's because they're in a different stage of their investment journey. Or if the market conditions change, there may not be as much NAV erosion. You know what? That's fine. That's more than fine. So anyway, key characteristics. I really covered this. I'm not going to read this. You can read this. Let's do the side by side here. So basically, here you got NEOS on the left, Goldman Sachs on the right. So QQQI, GPIQ. You can see that the share price very similar. It's in the low 50s. QQQI was launched in January of 2024, GPIQ October of 2023. These both are replicating and selling covered call options on the NASDAQ 100. NASDAQ 100 is a very tech-heavy index. Your top holdings in the NASDAQ 100 are NVIDIA, Microsoft, Apple, Amazon, Google, the big boys. Okay, options strategy. This is where things start to diverge and they get interesting. So QQQI is an actively managed ETF, as is GPIQ. Okay, that's where the similarities end. QQQI has a higher distribution yield, much higher than Goldman Sachs. Go down here a little bit, 3 rows. Their annual distribution yield is 13.68%. GPIQ is 9.85%. Wow, that's a big difference. Okay, now this next piece gets to the options overlay strategy. QQQI is going to sell covered call options on anywhere from 50 to 100% of their holdings. GPIQ is going to not sell as many. They're going to sell covered call options on anywhere from 25 to 75% of their holdings. So, I would say that QQQI has a more aggressive pricing strategy because they're putting more of their holdings up. But they also have more of an aggressive pricing strategy because they're setting their strike price at the money or in the money, whereas GPIQ sets that strike price out of the money. What does that mean? When you're selling a covered call option, you're entering a contract and you are setting a price for the option. And you're basically saying, okay, I'm going to sell you this option and I'm going to sell it for you at this price. The current market price of this holding is X dollars. I'm going to set the price of this option at X plus 1% or X plus 2%. That's at the money or in the money. Okay. So basically, you're saying, I'm going to optimize and maximize the premium you're going to pay me for this option, but I'm going to take on more risk because if the market price breaches the strike price that I'm setting in this contract, the option will be assigned and I will be required to sell my shares. I'm going to keep the premium, which is great, but I'm going to basically be forced to lose my shares while the market price continues to rise. What does that mean? That means that I have missed the upside. Okay, let's say the holdings go up 10 or 15 or 20%. I've missed that. Okay, because I got the higher options premium and I sold at X plus 1% or X plus 2% after the market price passed it. Conversely, with GPIQ, they may be setting the strike price 5 or 6 or 10% outside of the money or above the market price. There is less of a probability that the market price is going to breach the strike price. It could happen, especially in today's market. And that's why they sell fewer of their holdings. They range it from as low as 25 to 75% versus QQQI, which is 50 to 100%. I will tell you that Goldman Sachs is probably selling 25% right now. They're not selling 50, not selling 75. QQQI is probably selling 50. So they're a little bit more aggressive. They're taking on more risk. More options are going to be assigned in this market. Okay, and so there's going to be more upside missed by QQQI than there is by GPIQ. QQQI is going to collect more options premiums because remember, they got a higher annual distribution yield. So that's where they're getting their return. QQQI is getting their return through income. GPIQ is getting their return through price appreciation or growth. They're retaining their shares as they grow. That's just a difference. And I'm not going to say one is better than the other. I have a preference. I like the growth strategy. But I may get to a certain point in my investment journey where I want to have more income. That's a very different thing. It's a preference. And then there's also market conditions. And I did touch this here. We're in a bull market. So for me, and I sell options on stocks, I sell fewer options today than I do in a bear market. And I also, when I do sell them, I set that strike price further out of the money because I do not want to have the option assigned and the shares sold. I want to keep the shares and I want to do a trade another day. Um, okay, so they're both monthly payers. NAV trend is increasing for both. These are both solid, sound ETFs. Okay, they do not have a declining NAV or NAV erosion. But one today is performing better than the other. Um, but before we get to the NAV performance, look at price performance and total return. So 2025 year to date, it's GPIQ 3.92% price return versus QQQI's 2.56. Total return year to date, guess what? Because of those high distributions, it's QQQI 11.53% versus GPIQ's 11.44%. Same thing for the 1 year time horizon. Price return 1 year, it's GPIQ. Total return 1 year, it's QQQI. Inception to date, wow. Now, you know what? This basically speaks volumes. We are in a bull market. We are in a massive bull market. We have had corrections, but look at the difference between the price return and the total return, okay, between the two. So price return, QQQI, inception to date, 7%. Price return, inception to date, GPIQ, 31%. My God, that's more than 4 times. Total return, inception to date, QQQI, 32.79% total return, inception to date. GPIQ, 58%. Wow, it's killing it. Okay, and so it's really, this is because of three things. Why is this outperforming QQQI? It's outperforming it because for this market we're in, it has a better options overlay strategy. It's selling fewer covered call options. It's also setting its strike price further out of the money. Also, it has a lower expense ratio. Okay. Expense ratio comes out of the fund. They're to pay salaries for the staff. That's what that is. Okay, NAV return, this is closer. And so basically, NAV return is what is the return of the net asset value and tracking the differences, year to year, I think is instructive. Sometimes that stuff is hard to find. I go into Morningstar and I look and I can find NAV return. So NAV return year to date, very close. QQQI 9.41%, GPIQ 9.5. 1 year time horizon 22.6 QQQI, 21.7 GPIQ. So they're trading here. NAV return inception to date, not even close. GPIQ 57%, QQQI 31%. We're in a bull market. That's the difference. Okay, and the options overlay strategy of GPIQ is a better strategy in this market. Now, in a bear market, things will flip. I haven't seen them perform in a bear market. We'll have to wait and see, them being GPIQ. But I will tell you, I own both of these. I have more GPIQ than QQQI, and I think that's the right approach in this market. But if we start to go into a bear market or we start to go into a sideways market, I'm looking at the bottom line here, I will probably reallocate some of my holdings from GPIQ into QQQI. So, folks, that's it. And then let me answer the question, what is the better covered call ETF? The answer is it depends. It depends on your preference. It depends on where you are in your investment journey. It also depends on the market conditions. So hopefully I've answered those questions for you, and I hope you found this thought-provoking and informative. Before I close, just a friendly reminder, as an affiliate of Seeking Alpha, I can offer discounts to the premium, Alpha Picks, and the bundle subscription. Premium is absolutely wonderful. You will be joining 250,000 other subscribers, numbers probably higher, that have access to cutting edge investment insight and analysis 7 days a week. 24 hours a day. You get a discount. If you sign up, you get $30 off the normal annual price. You also get a 7-day free trial. Sign up, you don't like it, cancel it after 7 days or before 7 days. Alpha Picks, I love this. I subscribe to both of these, so I'm really kind of a bundle subscriber. But basically, with Alpha Picks, you're getting 2 free picks every month from their outstanding uh, investment analysis team. And these picks kill the S&P 500. I got to tell you, I love Alpha Picks. I have them both. I'm providing the links here. You go to those links, or you go to the QR code. You can sign up and get the discounts. Here's a little bit more you can read. You can read the bullets, but I think I covered it for you. And there's the links again. Now, also on the left part of the screen, the lower panel, you'll see that I am on multiple platforms. So in addition to making videos here, which I really love doing here on YouTube, I'm also providing investment analysis content, dividend content on X, on Instagram, and on Facebook. So check us out. The handles are there, as well as the QR codes. And folks, that's it. Thank you. I hope you liked the video. Give us a like, share with a friend, hit that notification bell so when the next video comes out, you will know. And we would love to have you join our wonderful subscribers. We have over 650 and we're growing. So would love to have you join. Please join, and we'd love to have you comment, provide feedback, and also ideas on new videos. I get ideas from our wonderful subscriber family. So hope you consider it. Have a wonderful, wonderful day. And until our next video, God bless.